Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital. And I'll be a son of a gun. Look who's here, Mr. Michael Becker.
Hey, Paul.
The man himself.
Yeah, I'm not on a due diligence assignment today. It's good.
You are one of the busiest guys I know.
Lots of assignments.
So Michael's in the podcast today, so we appreciate that. Also came in all the way up from Austin, Texas, Mr. Hans Box with Old Capital. Hello, Hans.
Hey, Paul. How are you? Hey, Mike.
Hey, Hans.
So everyone's doing great. So I thought we'd just kind of talk a little bit about what's going on in the Old Capital world. Don't forget, on March 30th, we have the Old Capital 3-on-3 half-court basketball tournament that's sponsoring for homelessness. So Hoops for Homelessness, we love for you to participate on that. We want to make it a success for a worthwhile cause. Go on to the Old Capital Podcast and register. We'd love for you to play some basketball over at the SMU Dedman Center on Hoops for Homelessness on March the 30th. We'd love to see you. On April the 3rd, we have Dr. Dotzer coming in. Yes, the doctor, making a house call on an annual basis to the speaker series. We'd love for you to be there too. So Dr. Dotzer will come in April 3rd to give you his injection of hopefully confidence in the market itself. As you know, everyone listens to Dr. Dotzer. Whether you are an investor or you are a banker, he is the guy that everyone listens to get the projections of what's going on in the economy. He's very good.
If you want to find out more information about that, what do you sign up for those, Paul?
Oldcapitalpodcast.com. Oldcapitalpodcast.com. Go onto that and sign up to listen to Dr. Dotzer.
Yeah, he's great. He's takes a seemingly dry subject sometimes and makes it pretty entertaining. So definitely it'll be, usually 400 to 500 people come out to see him. At least that's what it was last year. Yeah,
it's always a great event for him to attend. So but I really want to kind of find out what's going on. And so we have two smart guys in the room with Hans and Michael. But the man I want to kind of find out what's going on, the guy who really understands what's going on with apartments economics, is a guy named David Kahn. David Kahn has been with us a couple times. He has been in the podcast before. He's also spoke at the speaker series, and he is going to speak tonight when we record this at the Grapevine Convention Center. We'll have 300 people there to listen to David and kind of understand a little bit more about what's going on. So he's going to share with us a little bit about his presentation that he's going to present tonight. So David, thanks for coming in. We appreciate that.
Great. Thanks, Paul.
So David, as you know, he's a graduate of Johns Hopkins University, and that's in Baltimore, right?
Baltimore, Maryland.
And you are a specialist in multifamily, so you really focus on, say, the big picture, but also specifically on Texas and specifically on Texas apartments. Is that right?
Texas apartments and in particular DFW.
So that's great. So I'm going to go over to the Grand Inquisitor, Mr. Michael Becker. Let's kind of kick it off.
Yeah, David, maybe first, for those that didn't hear your podcast last time, maybe give a little quick bio on yourself. And you work for CoStar. Maybe kind of give a 30-second commercial of what CoStar is. I know it's a big company, so I don't know if you cover everything you guys do, but maybe kind of the high level.
Sure. So CoStar is the commercial real estate, both marketplace and data information warehouse, if you will. And I'm on the analytics team at CoStar. So we write market, sub-market reports in 390 metros now. Those include economic forecasts. And we have about 60 economists who do those reports. And my role at CoStar, I've been covering DFW for 4 years, been with the company for 5. And I am dedicated to the Metroplex, the 4 major property types. But multifamily always has a place in my heart, and it's one of the more fun property types to cover. And again, thank you for having me back. I love to chat with you guys whenever possible.
Cool. Well, maybe we can kind of start like big picture and work our way down a little bit. So the question I always keep getting asked by existing investors or new investors is like, is this all going to come to an end? Like trees don't go to the sky, and we were in 8 or so years or maybe more into an expansion cycle, maybe 9 years, I guess, into an expansion cycle and the U.S. economy. And everyone thinks it's on its last leg. But every time you turn around, it seemingly there's, good news economically, at least out there, and a lot of noise out there. So kind of what's your general take on the U.S. economy, and maybe give a couple metrics along the way?
Sure. So I completely agree with that assessment that it seems like everyone is looking for the shoe to drop at this point. We're so late in the cycle, and this expansion really has gone on quite long. But there's a lot to like about the U.S. economy right now, especially looking at the fiscal stimulus in 2018 did have a positive impact overall. GDP growth picked up. Job growth was actually stronger than 2017. And there were a lot of factors, especially speaking to the multifamily sector. Multifamily rebounded from more of a weaker year in 2017. So looking at it from the broader economic factor, there's a lot of factors in play. The Fed, obviously, number one on a lot of people's minds for good reason. Fiscal stimulus going away. But in terms of looking at multifamily, household formation has remained strong. Job growth remains strong, and wage growth is picking up as well. So when looking at, is there meat on the bone to raise rents? And we'll probably get into that more. But finally, people are getting a raise after years and years of slowing wage growth. Finally, wage growth is starting to pick up. So there's a lot to like nationwide right now. And as we'll get into DFW, we look really strong locally as well.
So I know we employ a third-party management company, but on all our properties, we probably have 150 on-site employees, something like that, for all the properties that we own. I know it's a struggle today. Anytime we have anyone turn over, there's constant pressure and poaching of employees to go other places. Mm-hmm. You mentioned that the wage inflation goes. Any kind of sort of unemployment stats or job opening stats, anything like that, kind of nationwide that you think are relevant and maybe could share?
Yeah, job openings are essentially at an all-time high from a nominal basis. So essentially, everyone who wants a job has a job. No, it might not be their ideal work situation. It could be part-time.
Can you talk to my brother-in-law?
Mine too.
I think we all have a few of those in our families as well. But on a macro scale, on that general basis, what we're seeing is wages are picking up. We're also bringing more people back into the workforce that might have dropped out. So again, those people are coming back into the workforce, forming households, and that directly translates to renter demand.
Yeah, wow. So then is that pretty much that's consistent for most of the major metropolitan areas across the entire country? Yeah,
and multifamily, as I mentioned before, has rebounded from more of a weaker year in 2017. 2018 record absorption, and that was nationwide, and lease up in many metros actually accelerated. So part of that is the household formation picking up. Headwinds would be because the economy is getting stronger. Home ownership rate is also rising as well. So that would be one headwind, but we formed enough households to make up for that and see really strong demand across the board, and not just the Sunbelt metros like we have been seeing, but pretty much everywhere in the country.
And supply, how was supply 18 versus 17? I know everyone keeps saying it's going to be peak year, and peak year keeps getting pushed out, another year and another year, just for various factors of not delivering as many units as we thought we would, because I know labor's been tight, materials, everything's just been a little bit harder trying to get these deals done. Was 2018 the peak year, or are we still looking for that in 2019?
Well, we have about 650,000 units underway right now nationwide. That's a lot of apartments.
Yeah.
And, 18 the peak year, 19, 17, it's all a lot of supply. So to call 1 year the peak year, it's difficult to say because, as you said, there could be more delays or what have you. Labor is getting tight, but it's been more of a consistent wave rather than a peak and then kind of a fall off. And that's what we've seen. And that's what looking at groundbreakings and especially trailing 12-month, which is a really good forecaster of future supply, we haven't seen much of a slowdown just yet.
So we think for the next 19, 20, we'll have generally pretty consistent deliveries, what we've seen in the last, say 17 and 18 nationwide.
It would be tough to forecast much of a drop-off through 2020 at least, just based off construction schedules and the pace of ground breaks that we've seen nationwide. Are you guys predicting that to go further, or is this kind of to be determined on what goes on in the economy? More to be determined, and 2020 is really the year that a lot of economists and a lot of shops are predicting, you don't want to say the R word, but a little bit of a slowdown, and that's baked into some of our projections that we do, third-party demand-side projections that we're beheld to. So We're getting more questions from, instead of taking a base case scenario in our forecast and our projections, more of a trend line forecast. So essentially what the cycle's done, forecasting that out rather than dealing with some kind of a downturn in 2020, 2021, and just to see how that would play out, which would be more consistent supply, but also more solid demand.
I know everyone's got opinion on this subject matter, but I wonder what yours is. Interest rates. So you mentioned the Fed. Obviously, it seems like the Fed was on the automatic course. They were, tapering $50 billion a month off of their bond holdings, and they've been raising, what they raised, four times 100 basis points last year, a quarter at a time. And, kind of going into the end of last year, it looked like that was going to be automatic and we're going to force a recession. All of a sudden, it seems like Powell turned around and the Powell puts in and he's become a dove all of a sudden. So it seems like the consensus is, 0 to 1 rate hikes in 2019, with most people thinking we're probably done hiking rates for the foreseeable future. And maybe even the tapering off of the balance sheet might be a little bit more modest or going away as well. What's kind of your thoughts? And then what do you kind of see going forward the rest of this year and kind of maybe even to next year? What's your crystal ball say?
Yeah, and you said it. I wouldn't say an accelerated pace, but it was a strong pace of rate rises last year, or acceleration. This year looking a lot more dovish, and inflation remains really stubbornly low, and that would be a good thing for the overall economy. The Fed's dual mandates of low inflation or manageable inflation and as high as possible employment. We're in almost a Goldilocks scenario in terms of looking at it from that perspective. So until the Fed sees inflation really pick up, there's no really strong reason to raise rates at an accelerated pace. The concern would be when we do hit that downturn, how much ammunition do they have to then cut rates back down to essentially zero, or in Europe, you see the negative rates, which I don't think anyone wants to go to. That causes all sorts of issues. But right now, and where we're standing today in early 2019, the fact that Chairman Powell is saying ease off the accelerator, it's definitely a good sign for growth in 2019, probably early 2020 as well. So
and one of the things that always kind of in the back of my mind thinks going to come back to roost one day is we're at somewhere around $21 to $22 trillion and national debt. We have a deficit of almost $1.5 trillion, I think, at this point now, and keeps seeming to be more and more now with the tax cuts from about a year or so, and the rates have gone up, so it kind of compounds the deficit on top of that. And we keep hearing socialist tendencies or more and more spending. Any thoughts on that and the kind of the future impact, or do you guys weigh that in any sort of forecasting potential impact of all the deficit that we have here in the country?
That's more of a long-term impact, and that's I'll essentially leave it at that. I don't really want to prognosticate on that side, but for sure it's a concern long-term, as is the viability of Social Security, other benefit programs. But the government has mechanisms to deal with that. Number one is what people wouldn't want to hear, and Hans
I disagree.
To raise taxes. So there are ways to deal with that may be unpopular, but it's possible, it's out there. But that's not a near-term issue, definitely much more longer term.
Got it. Okay, so maybe we kind of drill down a little bit more into a lot of our listeners, and most of the business we do is here in Texas. So do you have any sort of thoughts, just kind of macro of the Texas economy, kind of how that's been doing relative to, say, the U.S. economy? Because it seems like the U.S. economy is doing great. How's Texas on a comparison basis?
The rule of thumb is pretty much take the U.S. economy and double it for Texas.
Sounds about right.
Yeah, when you're talking employment growth, when you're talking population growth, everything here, and especially in the four major metros, works at about twice that rate on a percentage basis. So what that means is Austin growing at 3% population growth or close to that annually. Employment growth in Austin, very strong. DFW around 3% employment growth. And Houston, which saw that huge downturn during the oil bust, has recovered a lot of jobs and was one of the stronger metros for job growth last year.
Hans, too many cars with California license plates in Austin?
Yes. Yes.
What's your general feeling right now about Austin? I mean, you do a lot of loans in the Austin marketplace, and so thumbs up, thumbs down, thumbs in the middle. What's the kind of the overall general feeling of Austin?
Oh, it's booming. I mean, it's crazy that, obviously everybody's heard about the Apple campus that was built, and I think that was 5,000 jobs and could go up to over 15. Facebook is has 3 or 4 locations there. They're building another building right now. There's Google, there's Dropbox, there's just every technology company you can think of has an office there or headquarters there. So it's white collar jobs that are coming into Austin more. So on the apartment side, it's mostly, your AA type apartments are being built that are $3 a foot, because that's really the only people that can afford are the white collar jobs. So one of the issues in Austin that I've heard, living there is a problem is that there's lack of skills to fill the jobs. So it's the other way around. We've got companies that are having problems staying in Austin because they can't find enough labor, which is kind of interesting. I don't think it's going to hurt.
Blue collar laborers, like if you needed to have a sink
No, it's a
repaired?
skilled white collar labor they can't find. Even with UT there, A&M pretty close, there's not enough skilled population to fill all these jobs that have come in so quickly.
I think the tech skills.
Tech skills, yeah. I mean, it's kind of anecdotal, right? But it is an issue there that they're trying to solve because, and then a lot of people that come in have trouble living in interior Austin. Commuting is tough there, as you guys know. So it's probably the most expensive city in Texas to live. So when you're building apartments downtown in Austin, it's at least $3 a foot for apartments. And that's tough, even for a white collar worker that starts their job at $60,000, $70,000 a year. That's a tough housing amount to pay.
With a lot of student debt and a car payment.
Exactly.
Yeah,
exactly.
That becomes troublesome.
Well, Hans's anecdotal observations here, backed up by any sort of stats that you see about this, kind of going to the 4 major metros now. What do you think of Austin? What are you seeing in the numbers, David?
That tight labor market in Austin, I think unemployment is below 3%. So that's as tight as you're going to get. That's structurally no one is
except
unemployed.
Midland, Odessa. I think
yeah, which is quite a market. But yeah, we're seeing that from a multifamily fundamentals perspective. Austin was weak from 16 to 17, and that was due a lot to overbuilding. Austin doesn't have that cushion of B and C class that Houston and DFW have to almost cushion the blow from overbuilding in the A class. Almost everything is brand new. I think 33 or 35% of all apartments were built since 2010 in Austin. So when you see a little bit of an increase in supply or a little bit of a dip, you can see rent growth fall or flatten out or really spike like it did last year. So Austin rent growth in 2018 was actually one of the strongest of the major metros.
And it was negative in 2017.
And it was negative in, I think, 16 and 17 were flat.
All these people wanting to move to Austin means I'm going to have to wait in line longer at Franklin Barbecue.
I've never waited in that line, Paul.
Maybe moving just down 35 a little bit to the south, San Antonio. What's kind of your observations on San Antonio? How's that doing?
Slow and steady. I think that's the term everyone uses for San Antonio. It still has a lot of strong growth. Actually, millennial growth is strong there on a percentage basis. It's just more of Fort Worth to Dallas would be San Antonio to Austin. More blue collar, military, insurance presence, call centers still. That's more of your San Antonio, and that's more of your workforce housing. Even the new product in San Antonio, in a lot of these places, rents for $130, $140 a foot, and isn't highly amenitized. So much more of that blue collar workforce housing that is still getting built there.
So the anecdotal evidence or anecdotal conversations I have is San Antonio is pretty flat, and the top of the market's having problems staying full, and the rent growth is negligible at the top of the market. That maybe they've oversupplied. Certainly the top market. Is that kind of your consensus when looking through the data?
Correct, and we haven't seen the rent growth pop like in some of these other metros. Just more steady, slower. I think rent growth peaked at 4%, while nationwide it was 6% or so in 2015. So a little bit slower growth. Still a strong market from a demand perspective, but because there's so much building going on and not that same type of job growth in the other Texas metros, a little bit more of a weakness.
Moving down to Houston, you mentioned that it obviously has recovered a bunch with jobs. Is that largely in the oil field? What have you guys seen with the post-hurricane? I guess we're, 20 months past the hurricane now. One of the fears I had about Houston was all of a sudden they had a high amount of vacancy, and then overnight that went away with the hurricane. And as those displaced homes get brought back online, can they sustain that occupancy, or is it temporary? What are you seeing in the data?
And that's what's happened. We saw the Harvey bump. Rents went up 3-4% overnight, essentially, and slowly but surely those renters of the A-class apartments in particular have migrated back to their single-family home. So Houston rent growth last year was pretty flat overall. The economy, the headline job growth numbers are stronger. But again, the question is how many of those jobs are temporary from rebuilding the homes, construction jobs, but also temporary construction jobs with all the petrochemical plants and everything that's going on near the port of Houston. So that's the concern with Houston. I'm definitely not the authoritative voice on Houston. We've got a couple of people who really dig and dive into that, but it's such an interesting market from that perspective. You have the port of Houston, and that's booming right now. You have the Texas Medical Center, and then you have a lot of energy, which ebbs and flows with the price of oil.
Has the developers picked back up on the supply too to throw another monkey in the wrench on top of all that toxic cocktail you just mentioned?
Not really.
No.
It's hasn't recovered in terms of groundbreakings yet, which is definitely a good thing for existing landlords. The thing going forward is population growth, household formation still strong in Houston. It still benefits from the Sunbelt migration, but the question is how many of those are going to rent those high-end apartments.
Yeah.
And those require the top of the line oil energy jobs and higher paying office jobs.
Good. And moving to our backyard, our hometown, DFW, any sort of thoughts on DFW as a macro when it comes to multifamily or just kind of as an economy as a whole?
Well, household formation and housing units, what I always like to go back on, including the single family, is essentially at equilibrium right now, which is strong. We're adding as many households as we are adding housing units. So that means that we shouldn't expect much of a slowdown in rent growth going forward, and vacancies shouldn't spike to the point where it would be concerning. So that's number one. Number two, looking back to 2017, late 2017, or even early 2018 when we last talked on the podcast, there was a lot of building up north in the northern Dallas suburbs, chasing the Toyota, Liberty Mutual, JP jobs. And there was definitely some oversupply there last year that's burned off, and groundbreakings up there have slowed recently. So looking forward, those submarkets, Plano, Frisco, have underperformed, but looking better going forward. And overall, we're adding such strong household formation that it can peter over some near-term oversupply issues, and that's what we've seen. So 2018, rent growth essentially the same as 2017. Not anything to write home about, around 2.5%, but better than inflation and better than the historical mark.
So there's a lot of supply, obviously, up the tollway, both south and north. So you mentioned kind of the northern suburbs. What about uptown? That's obviously uptown, in-town Dallas is where they delivered, as much or more supply than even the Frisco Plano submarket. What have you seen over there? Because we were looking at a couple deals last year, thinking we might be able to get a steal, and everyone was offering 6 to 8 weeks in concessions. And on top of that, you had to pay a locator, 4 weeks worth of locator fee on top of it. So effectively is 25% concessions essentially effective into these deals. What are you seeing in the kind of the in-town Dallas market?
In-town properties haven't quite recovered to the point where landlords are comfortable pushing rents, but it's started to level off compared to the really overbuilt times of late 16 and through 2017. And groundbreakings in the urban core have slowed pretty substantially over the past few quarters. So looking forward, as long as groundbreakings don't pick up again, which it doesn't look likely in the near term, those East Dallas, uptown, downtown will have a little bit of time to recover before the next big wave.
And that's materially different than, say, like Austin, where Hans' backyard, where the urban core is almost leading the rental rate projections and growth, correct?
I haven't looked at that, but you would know better than I.
Yeah, I mean, there was some oversupply, but I think, like you said, it's picked back up there, and there's really not many other places to build in downtown Austin. It's pretty constricted with the river and the hills there, so except east.
Yeah,
East Austin.
You can go east, and they've already started doing that. Endeavor has a hundreds of $1 million development there with a Whole Foods in it, and it's expanding every day there.
And so back to Dallas Fort Worth. So it's always a tale of two sides of the market. So you got the Dallas side and the Fort Worth side. So you said the market as a whole was about 2.5% or so in rental rate growth in 2018. How does that break down between the Dallas side versus the Fort Worth side as far as the percentage of growth? Are they about equal, or is one a little bit higher than the other?
Fort Worth's outperformed Dallas recently. So when we're talking the 2.5%, and of course they don't have the same amount of inventory, but Fort Worth, you're looking at on a submarket level, North Fort Worth did well last year. Southeast Fort Worth, the Mansfield area, up through Arlington and through the mid-cities has outperformed in recent years. Even Southwest Fort Worth, which has seen a lot of supply along Chisholm Trail, TCU area, and up through near Southside, also performing relatively well. So it's tough to point out any real weak points in the Fort Worth side. And that's really the strength overall of what's going on there. Strong demand for the workforce housing and the A-class product, which really didn't exist in Fort Worth until pretty recently, has done well.
Yeah, good. Why is that, you think? Is it just a function of the lack of less supply in Fort Worth, or is it the type of jobs, or what's driving that outperformance relative to the Dallas side?
Lots of jobs in the workforce housing, logistics sector. The trade transportation sector in DFW is the biggest super sector as defined by the BLS. And DFW as a whole has added about 20,000 of those jobs over the past 12 months, continues to add those jobs at a strong pace. And a lot of those are over on the Fort Worth side of the Metroplex, up in Alliance, also near the airport.
We talked about a little bit about industrial areas creating jobs. Tell us a little bit about how many square feet do you have to add, and does that equate out to how many jobs you can have?
The rule of thumb used to be you have a 1 million square foot bomber. That would translate to around 1,000 jobs. But what we've seen lately and looking at the announcements and how they're penciling out, we could probably look a little bit less than that, more like 500, 600 for a 1 million square footer. And it really just depends on the functions in that particular warehouse, how much of it is robotics, how much of that is automation, and how many people you need to run that, and how many shifts are you running as well.
Again, how much square footage is being built right now on the industrial side?
Just about 25, 26 million square feet right now. Drop in the bucket.
Let's see. Divide it out by 300. That's a lot.
It's a lot. It's number one in the country. Inland Empire is close, the San Bernardino area, but we've consistently in DFW added 20 to 25 million square feet since 2014.
It really is amazing the amount of growth of industrial around the airport itself, especially on the south side of the airport. I mean, in the last, say, 3 years, that has absolutely blown up. So kind of central between Dallas and Fort Worth. And, I can see a lot of jobs, a lot of opportunities for apartment owners that are close to the airport in that area.
Absolutely.
What about the office? You cover all asset classes. So you see the headlines for, 14, 15, 16, 17 Dallas is just adding, millions and millions of square feet of office, a lot of it for user. And, I always, back in the bad old days, I'd always think of, Dallas Fort Worth having, when I loaned on office buildings back in my past, you would think of Dallas being in the kind of the mid to high 80s occupancy kind of across the metropolitan area. And I'm hearing, we're now, in the 90s for sure.
Is it that high right now?
We're around 85% occupancy.
Okay.
That includes the entire Metroplex, and there's some areas that are structurally high vacancy.
Like down in the urban areas or even the...
Downtown Dallas in particular, and then some of the legacy submarkets along the mid-tollway area along LBJ.
Yeah.
But even those have recovered and have done better than historical norms.
And so what are we seeing? I know there's a bunch of big users. You mentioned Toyota, Liberty Mutual, State Farm, JP Morgan Chase, millions of square feet. But just between those people, what are we seeing for new office jobs and new supply coming into our market? There's
still plenty of built-to-suits on the way. So American Airlines taking a huge chunk of space. You probably see it every once in a while driving by. 1.7 million square feet. Pioneer Natural Resources in Hidden Ridge. Out in Westlake, you've got Charles Schwab. That's going to be 5,000 jobs when it's totally built out. So those big users still definitely very active out here. But the real story last year, at least to me, was there was a lot of spec in Uptown, Downtown, and then up in Frisco and Legacy, and it's leased relatively well. There was a lot of concern about that, but some big leases signed. Most recent one, Salesforce over in the Union. That took a huge chunk of space. 1900 Pearl, almost entirely leased at this point. And up in Frisco, those deals have done well as well. So there's tenants willing to pay those high prices. And if they're willing to pay those high prices for real estate, they're willing to pay their employees well and to locate in those premier areas. So, those are people who are coming in, they're being paid higher, they can afford higher end apartments, you can afford a higher end home. So it's strong for demand in really all sectors when you're bringing those people into the Metroplex net new.
Is there, you kind of gave that old rule of thumb of about, 1,000 jobs for every million square foot, which might be more 500-600 on the industrial side. Is there any sort of rule of thumb? If I see a 500,000 square foot office building being developed, is there a rule of thumb of how many jobs that might deliver to the area?
Well, we're packing more people into office buildings than we ever have. So the real rule of thumb in coastal metros is typically 200 square feet per employee. It's a little bit higher here for various reasons. We do have more of those sprawling campuses, so we trend higher than the national average in that point, but 1 to 300 or so, depending on where you are. If you're in uptown, you're going to get a tighter ratio. Companies are going to pack more people into that space. So 1 to 300, 1 to 250 can often be a good rule of thumb for you.
Let's get back to apartments, because
Yeah.
I love talking apartments. And so tell us some good submarkets that people should be looking to get into. Just between you and I, David, where should I invest?
Just between us, Paul. Right now, the Southeast Fort Worth, I mentioned it before, with 360 opening, the extension down there, seeing really strong performance in a lot of those properties. A lot of them are newer, pretty high end, but that submarket's been a consistent outperformer lately. Similarly, Southwest Fort Worth, it's really follow the new highway arteries. So where the highway arteries come, where a big expansion happens, you often see better performance in apartments in those particular areas. Last time I mentioned the Farmers Branch mid-tollway areas, and it seems like developers have caught on to that, and over 4,000 units are under construction.
One
there.
developer for sure, right?
Yeah,
That's half
for
of
sure.
them. So
Right.
JPI.
But right now, and I mentioned a little bit before, but those northern suburbs that have been hammered by a lot of people lately in terms of slowing rent growth and a little bit weaker demand than expected, the Planos, Frisco, Allen, McKinney, they're not going to stay that benign for long. And we've seen groundbreaking slow pretty substantially over the past few quarters. So if supply really slows down at this pace and you don't see those groundbreakings pick up, I could see those submarkets doing better than what they have over the past few years.
So, our business and the business that people do a lot of the investing is in the B and C properties. So can you help me understand a little bit more or define some better submarkets on the B and C side?
The mid-cities have always been great, at least this cycle, with those industrial jobs. Chasing the industrial jobs, the blue collar, that's really the bread and butter of that area. And we haven't seen much supply. We're seeing a little bit here or there in HEB. We're seeing a little bit here or there in Arlington, but in general, not to the scale that's really needed to heat off really strong rent growth that we've seen. So are we going to see peak rent growth like we saw in 2015 in the mid-cities? Probably not, but it should still outperform the metro average.
What's our occupancy right now in the B and C space right now, and where do you see the projections to be?
Been hanging around 95% over the past few years, and that's what we're projecting out, at least in the near term. It's tough to project any rise in vacancies in B and C when we're not building it, and those deals still don't pencil from a ground up perspective.
Yeah, they're building C-class properties, but they won't be C-class properties for another 40 years. I do see a little bit of a problem with wage inflation up in areas of like Legacy and a little bit farther up towards Frisco and Allen. I mean, there are some areas that have the B and C properties, and people are not paying $2-3 a square foot in rents, but they're paying $1.10 or $1.20 or $1.30. And that's probably the top end for them to spend on that one. And so they typically live down in southern part of Dallas or Richardson or Garland or even out towards East Dallas or so, and have to commute up to Allen, to Frisco, to some of these areas in North Dallas. And they got to be paid more to get up there because their travel times and commutes are so much higher than if they were to work at a restaurant job or a blue-collar job in and around the area. I see wage inflation in some of these areas farther north of the metropolitan areas.
Yeah, definitely.
Well, good. Anything else that we should have asked you? Any sort of other nuggets that you that are interesting to you that you might want to share with the group?
Nothing in particular. Just wanted to also mention CoStar LoopNet as well, one of our marketing arm for your marketing properties, and of course apartments.com. But obviously,
It's everywhere, huh?
It's everywhere. Brad Bellflower, you can't get enough of that guy. But Yeah, would thank you for having me again.
Now, David, we're looking forward for your presentation tonight at the Grapevine Convention Center. People would have already attended, but this was a great reminder that CoStar is the leader of apartment information across the United States, and a great way to get great and critical information if you're an investor. So get a CoStar account or start off going through, what's that retail site you guys have again?
LoopNet.
LoopNet is something for people to maybe get access to kind of understand a little bit about the definition that CoStar brings to the table, kind of an introductory way of getting into CoStar. So we appreciate that. Hans, thanks for driving up and visiting us with us today. Thanks for participating in the podcast.
Enjoyed it. Thanks for having me, Paul.
David Kahn, always a pleasure. Your information is critical, so thanks for being part of the podcast.
Thank you, Paul.
Michael Becker.
Glad I wasn't on assignment today. It was good.
He typically is on assignment.
Paul assigns me a lot of things, evidently, so it's good.
He's always on a due diligence assignment. So Michael Becker in the studio, so thanks, Michael, for being part of it. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.